Hi, my name's Ian Stevenson. I'm head of dental with Wesleyan, and I'm joined today with Wendy Baille. Hi, Wendy. Do you want to introduce yourself?
Hi Ian, hello everybody. Yes, I'm Wendy Baille. I'm a regional manager with Wesleyan and I look after all of our advisors across Scotland and Northern Ireland.
Great. So, Wendy, what we're going to discuss today is we're going to have a look again at the post-budget analysis of some of the announcements from a few weeks ago, specifically lifetime allowance and annual allowance, if that's okay. So let's just put some meat in the bones of some of these budget announcements. So we'll just spend some time breaking down what some of these are and how they impact on financial planning for medics and dentists as they head towards retirement. So can we start with the main change, the one that everybody's talking about, the one that grabbed the most headlines, and that was abolishing the lifetime allowance. What was the limit pre-budget and what has changed, Wendy?
So the lifetime allowance, if just so everybody's clear on what it is or what it was the maximum amount that you could have in pension savings before you were hit with charges at the point where you accessed your benefits. Now, pre-budget, the lifetime allowance was sitting at 1.073 million. So it had come down quite significantly in recent years, and you'd be sat with that if you hadn't protected a higher lifetime allowance earlier on in your career. So we expected it to increase at the budget because there's been a lot of noise around it. It was originally intended to be a kind of rich person's tax, and it really isn't. I think if you are one of our clients who works full time, then definitely you would have been facing lifetime allowance charges at the point of retirement, which is really unfair. So it's great news that they've now abolished the lifetime allowance and you can have as much money as you want in your pension pot for your use at retirement without having to consider lifetime allowance charges.
Okay, thank you, Wendy. So how has this impacted the pension commencement lump sum, otherwise known as tax-free cash?
So your tax-free cash traditionally is a maximum of 25% of your total pension pot value. And for the pre-budget lifetime allowance, that equaled £268,275. What's happened now with abolishing the lifetime allowance is that they've still retained that cap on your maximum tax-free cash. So your tax-free cash cannot increase above that unless you've got some pension protections in place, regardless of how much money you've got sitting in your pension at the point of retirement. So what that means is that everything above that is going to be taxable when you access your benefit.
Okay, that makes sense. So what impact do you think this might have on where to save and invest as you plan for your retirement?
Well, I think for all our clients out there who've not maxed out their tax-free cash, then it's a real opportunity for you guys to have a look at, well, can I do further pension planning? Or is it better to do it somewhere else, in some other sort of vehicle other than pensions? For clients who have maxed out their tax-free cash, and again, for most of you watching this who have been in full-time work and have been in the NHS pension throughout that period of time, you're going to be in that position. It's actually very difficult to look at, well, how can I get any more benefits from doing further pension planning? But there are still good opportunities for using pensions around things like legacy planning. So there's lots of different avenues that you can go down and lots of different things that you can use your pension for going forward. And it's not really straightforward and it's not the same for everybody. So it's a real opportunity now, Ian, I think, to seek some advice. And of course, your Wesleyan specialist financial advisor is absolutely on the front foot with this to help you.
Okay, yeah, that makes perfect sense, Wendy. So just being a bit more specific, looking at tax in particular. So what does this mean to the tax that you will now pay on your pension income versus what you might have been the case if you were over the lifetime allowance?
Okay, so the lifetime allowance at the point where you access that money If your pension is a pot of money pension, then anything over and above the lifetime allowance would have been taxed at 55% if you took that money as a lump sum. If you took the money as income, the money that you took would have been taxed at 25% as a lifetime allowance charge, and then you would also have had to pay income tax at whatever tax rate you pay on top of that. So effectively, it meant that you were paying the same. So it's quite a substantial tax that you're saving. But what we're looking at now, because we've got a cap on the tax-free cash proportion of your pension, anything over and above that is taxable at your normal income tax rate. And what that means, Iain, is that if you are a higher rate taxpayer and you access that pension, then you're going to pay at the very least 40% tax on the money that you access over and above your tax-free cash. And it could very well push you into additional rate tax as well. So you're looking at paying 45% on that money rather than 55%. So a definite saving, but not a substantial saving.
Okay, I think that's a really important point just to bring out here. I think that helps Wendy just to illustrate the need to have a look at their own individual circumstances, doesn't it? I think it's vital that people just don't look at the headlines and then make decisions based on that. Okay, Wendy, so let's turn to the annual allowance. Can you please talk through just a quick reminder of what the annual allowance is and how it affects retirement planning?
Yes, Iain. So the annual allowance is the amount of money that you are allowed to put into your pension in any one tax year without incurring income tax charges. Now, because we're talking NHS pensions, the annual allowance isn't in any way related to the contributions that you make. Your contributions are just a tax. What it is related to is the growth in value of your pension from one year to the next. Now, the annual allowance before the budget was £40,000 each year. And from this year, it's increased to £60,000. And in addition to that, Iain, previously we had a real problem with the NHS pension and the growth due to inflation each year. There was a bit of a mismatch there, and it meant that our doctors and dentists were penalised for the inflationary growth in their pension. And that's not really what the annual allowance was all about or was intended to be. So what they've done is they've realigned the way that they calculate that so that now the calculation for annual allowance purposes will be based on the actual real growth in your pension and taking inflation out of the equation. So that's really, really good news for everybody watching. I think previously almost all of our clients were impacted by the annual allowance at 40,000 because of the changes in inflation in recent years. And now with those two changes, the increase in annual allowance to 60,000 and taking away the impact of inflation, that's a real win-win for us.
Yeah, thank you, Wendy. That makes perfect sense. I think it is worth reiterating the calculation if you're in what's called a defined benefit scheme, such as the NHS pension scheme, that the calculation for that is different from if you're paying to a personal pension. So again, it's worth just speaking to a specialist and someone who really understands that to make sure that you're getting all the information you need to do the calculation properly. So yeah, really good point, Wendy. So can you also then explain the impact on scheme pays? Just tell us a bit about what that means and obviously any impact on the scheme pays rules, please.
Yeah, so if you went over the annual allowance in any one year, you would have the option of paying any charges through your tax return, so it's just an extra portion on your tax bill every January, or nominating scheme pays, which means effectively that there's a debit placed on your pension, which is calculated when you retire, and it had the impact of reducing your pension benefits. Now that's not changed. It will just happen less often because the annual allowance has increased. But previously, a benefit of nominating for the scheme to pay that annual allowance charge was that it also had the impact that it reduced lifetime allowance charges. Now we don't need to be reducing lifetime allowance charges. It's really important that you rethink actually whether you need to do scheme pays or whether you want to pay that income tax in your January tax return, or what really is a benefit for you. And I think it all goes back to understanding what you need. Because if you understand what you need, then you can look at what options you've got around meeting that need and whether you need to do the scheme pays or pay the income tax.
Okay, thank you. Makes sense, Wendy. Thanks. Do you worry about just people hearing about lots of noise, lots of things happening, and it potentially being a bit overwhelming in terms of, does this affect me? How might it affect me? And therefore just deciding just to sit tight and doing nothing? I mean, what's the potential implications of that?
I do worry about that, Iain, and I particularly worry about our clients who have maybe made the choice to opt out of the NHS pension previously, and they've now got that decision to make around whether they should stay opted out or whether they should opt back in. And it worries me in case they just sit and don't get all the information and look at all the different facts and the different options, particularly for those clients. So I think it's really important for everybody to understand the impact on their own pension benefits that the changes have had, because as we said before, everybody is different. And it's really, really difficult. It's not something that you can just jot down yourself in a notepad and think, right, okay, I'm going to do this. Everybody is different. Everybody has different pension benefits, different personal circumstances, different objectives, different retirement plans. And so it's really, really important to understand how these changes impact you and then be able to amend your plans accordingly. I think part of that is making sure that you get a really good comprehensive cash flow analysis done around where you're at now, where you're going to be when you retire, and everything else will stem from that. I don't think you can go wrong if you do that, because you've got a really clear picture of where you expect to be. And if you know where you expect to be, then absolutely you can be certain that the decisions you make around your pension benefits are the right ones and are going to have the right result and the right impact for you and for your own personal plans, which are going to be completely different to your colleagues' plans. And again, that's what worries me, is if you just listen to everybody else's story, it's easy to forget that your story could be very different.
Yeah, I think that's a really vital point, Wendy. I think for me, financial planning has always been about that. It's not about listening to what your neighbour does or what the person across the street does or what the person online does. It's really important you take into account the big picture and what's right for you, what's right for your family. I think that when we were talking previously, we looked at this and we thought that this might give people more options. So some of these changes, which previously we would have thought might have encouraged people to maybe retire a bit earlier than they would like to have done, I think this now gives people a bit more of an opportunity to take a step back and think, right, what's the right thing for me and what should I do here? So I think your suggestion of sitting down, having a look at what we call a cash flow analysis, in other words, where you want to be in the next kind of 5-10 years, then it is absolutely sound advice, Wendy. So yeah, really good point. Okay, hopefully that's been helpful. We've tried to add a bit of information around some of the changes that are specific to retiring, some of the thoughts and potential opportunities and potential downfalls of not doing anything about it. And I hope you found this useful. So Wendy, thank you so much for your time, and we'll catch up with you all soon. Thank you.
Thanks, Iain.